Peter, I want to start off with the dollar. As Ben and I were talking about, it's firmed up. It's gone the opposite way from the very consensus view that has been bearish on this thing. But so far, it doesn't seem to be creating much problem for stock bulls. What do you think about that?
I think we got that bounce off, that resistance from 2018, as you pointed out. I think we see structural weakness. I think you keep seeing it go down. One of the big drivers is going to be the negative real yields in the U.S. As we start creating inflation, our yields are real yields. So if you take what we earn minus inflation, it's becoming the worst in the world. Japanese yields are much better than ours on an after inflation basis. Even Germany's starting to be that way. So I think that's going to put continued pressure on the dollar, and it's a structural phenomena that we're going to see through the course of this year.
Interesting. Okay, so the real yield staying negative, inflation creeping higher, basically means that your real yield gets negative by a treasury level that remains limited relative to inflation. Should bond holders be comfortable then? Is the complacency that I still see from most of my guests, Peter, in their treasury holdings okay then?
You know, we've been underweighting treasuries. We think we're going to see yields creep higher. So I see the 10-year right now, say, as in a band, call it, say, 90 bips to 130 bips. And I expect over the course of that year, that band is going to go and creep higher. So by the end of the year, maybe it should be 150 to 190. So it's going to be a gradual rise in 10-year yields. I don't think we have to worry about taper tantrum. The Fed is going to be very careful about messaging. They've got a lot of tools to prevent a taper tantrum. So it's going to be a gradual rise in yields that the market should be able to largely absorb.
Okay, Peter, you know I love this subject. It was something that I couldn't get out of my head pre-COVID, and then COVID came and we went back to our old ways of slashing rates and all that, and bonds rallied. We all know the story. But it seems to me there's kind of a similar setup again where we've got this economic awakening about to happen, kind of like when everybody was worried about the trade war and everybody said, oh, yields can't move, and then they started spiking from September to October, and then it just kind of stopped. But now we've got this steady trend since August. And Peter, when I think about traders and the way they view trends, we've had all these different events over the last 6 months. We've had political stuff. We've had good data, bad data. COVID curves go up and down. The 10-year treasury yield is like the most steady thing out there. So is there not a point at which investors will exploit that and say, hey, if this thing only goes one direction, I'm just going to sell it now? And then if everybody else does that too, isn't there a potential to spike no matter what the Fed says?
You know, I think there is that potential, but too many people still want the yield. The yield gets better every day. You've got pension funds coming in. So there's that demand for long-dated bond yields. The corporate issuance has slowed down a little bit as well. So again, there's a lack of supply. And ultimately, the Fed just has done such a good job in terms of, controlling this market. They can change the size of their purchases. They can change or target where they purchase. They can bring up yield curve control. So I think it would be a pretty heroic effort if anyone really went after this. And one thing that to me has been very, very important is when we had taper tantrum, all these fixed income ETFs contributed to that. You get all these strange discount to NAVs. You saw that again in March when we had credit sell off really hard. The ETFs were the leader. Since then, the Fed is able to buy ETFs through their secondary market corporate credit facility. So I think they will stop some of those triggering mechanisms. So I'm very comfortable this yield rise is going to be fairly gradual.
Okay.
Boring, and as a treasury trader, I wish it was more exciting.
The thing about the language is it almost seems like the more Powell talks, it's like the steadier the yield goes. I mean, in my mind, it's like the more dovish he gets, then the more certain we can be there's going to be inflation at some point, right? Because the more dovish he gets, then the more certain we can be that we're going to just keep heating things up until we get there. So it's like an inevitability. Why would a pension holder, have a bond at 1.1%? Do we know? That to me seems like a really important point, Peter, is what's the level of yield that will bring a pension fund in to really scoop it up and need it and find it attractive? Are we there already? Like, is 1.1% appealing?
No, but I think it's part of their gradual asset allocation. First, equities have risen so much, so there's a tendency to sell some equities, lock in some profits, put that into rates. Then on the other side, if you think about insurance products, right? Insurance products get sold every single day to you and I, other individuals. That money needs to be invested. They're not really there to bet on the timing. They're there to bet on, hey, we sold a product that needs X yield. We can get X yield, so we put money in. So there's that constant thing going on, and debt maturity. So at the big corporate end of these things, there's a lot of money that just keeps coming to work. And I think that's really the big driver.
Okay. Peter, this week, what are you thinking for employment, jobless claims tomorrow? Are we going to get some action? This ADP is a little bit surprising this morning.
Yeah, I think we're going to start seeing more signs that the economy is reopening. I think, certainly here in the Northeast, you don't see it as much, but when you start talking to people in other regions, you're seeing it. Some of our customers are actually starting to take face-to-face meetings, so I'm starting to work with travel because I would love to go and see clients again. So I think we're getting that reopening, vaccinations helping, comfort with, controlling the spread of the virus. So I'm looking for job data to improve.
Okay, looking for job data to improve. Not expecting a spike in yields, though. Where do you like to be in this market, Peter? It doesn't sound like you're gobbling up bonds. What about stocks? Are you in on the GameStop trade, Peter?
No, geez, I would not touch that with a 10-foot pole. That's the sort of thing I watch. I think that actually it will act as a bit of a headwind for markets. Certainly we've rallied very nicely the past couple of days, but we're going to see some regulatory scrutiny. I actually really, really like dividend stocks. I think anything that's paying a dividend right now, that could be a good alternative to bonds, right? And dividend stocks have lagged a little bit. And if we're in this, inflationary period, but negative real yields, I think dividend stocks should be overweighted. I like anything that still has this COVID discount. So I like the airlines, I like travel. That should get squeezed out. And that's kind of where I'm overweight. I really like this complete bounce back that we're going to get a good return. And the other thing I'm starting to look at more is anyone who really benefits from elderly spending. I think the elderly have really been able to save money because a lot of what they could do hasn't been able to occur. I think they're going to travel. I think they're going to spend money, so I'm looking for opportunities in that space.
How do you do that? Is that through stocks in the healthcare space? Stocks tied to what, Peter?
I think it's, again, going to come down to travel and leisure. I think that's where a lot of money is going to be spent. People want to see their grandkids. People want to see places they've always wanted to see and felt not only they couldn't, but hey, let's get this, let's do these things. So that to me, I think is going to be the surprise. Obviously that sector slowed down a little bit, but I think we're going to get another wave of buying in that sector as people realize there's going to be new pockets of travel that emerge.
Peter, I know that you've heard many talk about the barbell strategy of having some exposure to the defensive tech, but then also dipping your toe and reopen. What's the skew on the barbell the way you see it? Should we be 60% reopen, 40% the other stuff, or what?
I'm probably right now about 80% reopen, 20% big tech. I think big tech runs a little bit of risk of attracting, taxes. It's, Biden's mentioned taxes multiple times in that respect. We seem to have ignored it. So I think after this recent run-up, it's another selling opportunity. I think we could see the NASDAQ pull back 5 to 10% as some of these other stocks do a little bit better. So that's kind of my weighting right now.
Okay. Peter, I like it. Sounds like the only risk you really see here in the market is maybe a regulatory surprise or language from policy.
Yeah, I think on that side, on the positive side, I do think Yellen is going to do some really creative things. I think she is going to use her role and her past as a labor economist to really try and drive money to smaller and medium-sized businesses, maybe even individuals. If you think about the biggest complaint I think we hear across the board about Fed and monetary policy is it's really gone to the big companies. Every large company can borrow like anything they want, but it gets harder as you move down in terms of company size. So look for Yellen to use her role to figure out ways to expand that. Maybe taking some of the things that happened with the Main Street program where she had the banks act as conduits for Fed and Treasury money. So that I think is going to be the big surprise is money coming into smaller, medium-sized companies, and that will drive the economy.